transaction where one company has control over another company, and so we call that a business combination. So this is where we get into consolidations, the very first steps. So just to review some of this stuff, we've talked about it before, you've probably read it in the text. Just a little joke there. Business combination occurs when one company, which is the acquirer, with or obtains control of one or more businesses, because you can own more than one. Lots of companies do. Now, reasons for forming business combinations: you can defend, so you want to expand your market share, diversifying market or geographic region. You want to move into the States, like Tim Hortons did, to access new customers, product, services, expertise, or capabilities. Technology. A lot of business combinations with pharmaceutical companies, technological companies, and so on. So an investor controls an investee when it has power over the investee. It's exposed to rights to variable returns from its involvement. And the reason we say exposed to or has rights is has rights if the business makes a profit. Well, that's great. If they don't, if they have loss or multiple losses, you're exposed to it. That's why they say both. And it has the ability to use its power over the investee to affect the amount of the investor's returns. So generally we said 50%, over 50%. Let's say over 50%. Or they'll talk about it with different powers, just like we did with the significant influence. Okay, there are three main forms of business combinations. All three forms result in the assets and liabilities of the acquiree being combined with those of the acquirer in some manner. Okay? Now, generally the company doing the acquiring, so the acquirer, we're going to call the parent, and the acquiree, sorry, I'm losing my voice, is the subsidiary. So you can gain control of another company. You can purchase their net assets, which of course is assets minus liabilities. So you just buy them with either cash or shares, leaving the selling company with what they got for the asset sale and any liabilities present before the sale. So you can either buy the net assets, which is assets minus liabilities, so you take control of the liabilities, or you can just purchase the assets, in which case they'd be left with liabilities. Now, the combining of these assets will take place on the acquirer or the parent's books, much like the purchase of a single piece of machinery. So think, when you buy machinery from a company, okay, let's say they have machinery they're not using. So they're not a retailer of machinery. Well, you credit cash for what you sold it, and what do you debit? Machinery, and it becomes yours on your books, right? And on the subs books, they would debit cash and credit machinery, and don't forget, we debit accumulated depreciation, etc., and then there's a guess. So that's one way you can do it. And then you'll have control. You'll actually own all the assets. And in fact, those assets don't even have to come to your place of business. It'll be across the country, you own all their assets, they're just over there. Okay? Now, you can also the shares. So that's an alternative to purchasing the assets or net assets. So you buy enough voting shares from the shareholders of the acquiree or sub that it can determine, we can determine the parent strategic operating and financing policies. Share purchase can be less costly since you don't have to buy 100% of the assets. You can buy less than 100% of the voting shares to have control. Now, the new thing. If control is achieved by purchasing shares or through contractual agreement, which is 9, so we don't need to worry about that yet, the combining takes place when you prepare what's called consolidated financial statement under IFRS. ASPE allows the acquirer to use the cost, equity method, or consolidation. So we're mostly focusing on IFRS here for the rest of the course. So what happens is the parent has their sets of records, and the sub has their set of records. Okay? So those are their books. Well, because the parent owns so much of the sub, we do a statement that's our books plus the sub's books combined. And that's a consolidated financial statements. The sub keeps their own books out, the parent keeps their own books here, and we're going to pretend on a consolidation laptop maybe I'll just draw the circle here. Here's the parent's books here. On the consolidation laptop, we combine them, okay? Because we control the other entity. So our financial statements, imagine if we had 5 or 6 or 10 different subs. Do our investors, if we're the parent, go out and look up all those financial statements and then add them all together to see what effect it has on our financial statements. Do the individual investors have time to do that? Maybe some of the big institutional would, but they've also got 10 billion other things to do. So what they decreed was if you control a sub, then you have your own books, they have their own laptop, you are merged, and you do one set of statements. Okay? So up here, if we purchase the net asset, do we need to put them together? Well, no, because what do we do with these when we buy them? They go right onto our books. So those are on our books, the parent. So we don't need to combine them. But here they aren't. They're two separate entities. We just control them, so we have to combine them. So consolidated financial statements are additional statements that come what's called the separate entity financial statements under a hypothetical or pretend situation that they were operating as a single entity. And why do we do that? Because this company has control of this one. So we are showing to the investors, really, we're under control. We can determine what they sell, how much they sell, what they sell to us, for how much they sell to us. And so we're giving a clear picture of the two of them linked. But it's hypothetical because they're still two separate entities, so there's going to be two separate sets of books. Now, the consolidated statements should present the same results as if the parent had actually acquired all the assets and liabilities separately and actually bought them like this. Okay? The parent and sub will continue to record each entity's transactions, own accounting records. So under IFRS, they can either use the cost or the equity method to record the investment on their books. So what we have is the parent books, the sub books, and over here in consolidation land is what I call it. We have consolidated statements. These are separate entity statements. These are consolidated statements. Now, don't forget, and we'll see this, I'm going to do an example of this. On these books, little magnifying thing, there's a little T account that says invest in S. So when it says you can use either the cost or the equity method, that's what they mean on the parent's books. Okay, so I'm just going to recap this briefly, then we'll go on and start doing the examples. So if you buy the net assets, 100% of them, they all go on your books and it all be your company. So you don't need a consolidated statement, it is already mushed together. The books came, your machinery came on here, machinery left the other one. If you were buying all, maybe that was the only asset. All they'd have left is cash, whatever retained earnings. But when you purchase shares and obtain control, one, you can purchase less than 100, anything over 50, and you're good. And what happens is you keep your own books going, the parent, the sub keeps their own books going, but when it comes time to do statements, the parent has a little consolidation laptop out in consolidation land. It's not on its books. They put together consolidated statements which mostly take these two and merge them together, as if they would have bought all the assets. Okay? So, that was the second type. The third type is the one with contractual control. So, control through contractual arrangement. This is Chapter 9. And the control is based on a contract, as we talked about in Chapter 2. So we're not going to worry about that for a long time. So, under IFRS 3, there's one method of recording for business combinations, the acquisition method. And the acquiring company reports identifiable net assets being acquired at the fair value of those net assets, regardless of the amount paid for them. So as you know, from 315, when you did all the asset purchases and sales, you always acquire them at fair value, regardless of the amount paid for them. Of course, that does change if you remember correctly, if you're just flip-flopping assets back and forth, but don't worry about that. We're not going to do that. When the purchase price is greater than the fair value of identifiable net assets. Okay, let's say I'm selling my business and your business, is thinking of buying it, okay? And let's say I said my net assets, which is assets minus liability, were equal to 2 million, okay, in my business. And that's fair value. Okay, so someone came, rated it, said all the assets minus the liabilities owned is worth 2 million. Would anyone pay more than 2 million for those? Well, are all my business attributes mixed into the net assets and valued at that? Okay, what if I told you I had the same, been solid for 15 years, I've had good profit every year, and my employee turnover rate is very low? Is that valued in the 2 million? Nope. So it is possible you would pay more. And when you pay more, the excess is what's reported as goodwill. We always talk as companies about, oh, we have goodwill, you know, location, the customer base we built up, all that kind of thing. The only time you can actually have goodwill on a statement is when you buy another company, control of it. So, this is goodwill. Finally, we get to put it on our books. And that's just in the consolidated statement. Okay, just looking at the time. Let's see where we're going. Okay, sorry about that. I think I can get a couple more minutes. Okay, now, if the purchase price is less than the fair value of identifiable net assets, well, why would less than the fair value of my $2 million of net assets? Well, maybe my partner and I own it. Okay, we're both shareholders. And maybe we really want to get out. Okay? Or maybe we're ready to retire and we've got enough money, we just want to get this off our plates or whatever. So if that happens, someone might pay less than 2 million. So whoever, but you pay less than 2 million, you still report it at fair value, but the deficiency is going to be a gain. Okay? So if you're extra than the fair value, it's recorded as goodwill. If it's less, then you've got a gain. Okay. Let's just stop here so my recording doesn't kick me off, and then I'll keep going.